Monday's market delivered a clear warning. The early artificial intelligence rally attracted buyers, but it could not hold. Oil and Treasury yields rose, the Dow weakened, and the S&P 500 finished lower. The Nasdaq Composite held near flat because chip shares retained some relative strength. The one-line conclusion is this: the market is rotating, not collapsing, but failed rallies are replacing clean breakouts. Tuesday's most important test is whether buyers can reclaim the morning breakdown zones in SPY and QQQ. Here are the official index closes. The S&P 500 ended at 7,445.50, down 0.16%. The Nasdaq Composite closed at 25,531.75, up 0.05%. The Dow finished at 51,825.51, down 0.62%. The Russell 2000 closed at 2,951.33, down 0.37%. The split matters. Technology stabilized enough to protect the Nasdaq, but it did not generate enough breadth to support the Dow or small caps. The ETF scorecard shows positive momentum but weak participation. SPY closed at $742.04, down 0.17% on 42.72 million shares. QQQ closed at $696.06, up 0.10% on 27.62 million shares. SPMO closed at $144.50, up 0.42% on 1.82 million shares. Relative to their 65-day averages, volume reached 81% for SPY, 64% for QQQ, and 82% for SPMO. This was not a conviction breakout, and it was not a broad liquidation. The intraday structure was more important than the small closing changes. The open was risk-on, led by artificial intelligence and semiconductors. At the session peak, the Nasdaq was up roughly 1.2%, while the S&P 500 was up about 0.5%. Those gains faded through the afternoon as crude oil and Treasury yields moved higher. By the close, the S&P and Dow were negative, while the Nasdaq kept only a marginal gain. That pattern turns Monday's high into supply. A Tuesday bounce is not enough. The market must reclaim the failed rally zone and hold it into the close. For options structure, only verifiable information is included. VIX eased and remained below 20. However, the public end-of-day gamma model was not yet updated at the production cutoff. Net gamma, the gamma flip, the call wall, and the put wall are therefore unconfirmed and omitted. Those values are third-party estimates derived from options data, not exchange official figures. A lower VIX does not reveal dealer gamma. Until a timestamped closing model is available, price, volume, and official session ranges are the safer framework. 4 stocks define the day's story. AMD closed at $503.42, up 1.47%. Microsoft said it would expand deployment of AMD-TIC's Helios platform and EPYC processors. The next test is whether AMD holds 499 and reclaims 533. SNDK closed at $1,390.08, up 2.54%. It must hold 1,370 to preserve the memory rebound. AMC closed at $2.45.50, up 26.55% on roughly 183 million shares. Strong box office demand drove the move. WBD closed at $25.90, down 3.59% after a judge paused its merger for at least 2 weeks. 3 sectors deserve attention. The Semiconductor Fund, SOXX, gained 0.42% and closed at $524.35. The Microsoft and AMD announcement supported the early rebound, but much of the intraday strength faded. The Energy Fund, XLE, gained 0.47% and closed at $57.94 as crude oil rose. The Financial Fund, XLF, fell 0.39% and closed at $56.04. Higher Treasury yields did not create a clean bank bid. The day favored selective themes, not broad cyclical risk. Cross-asset pressure explains why the equity rally struggled. West Texas Intermediate crude settled at $83.23, up 0.9%. Brent settled at $89.22, up 1.3%. The 10-year Treasury yield rose to about 4.60%, an increase of roughly 6 basis points. Higher oil raises inflation risk, and higher yields increase the discount rate applied to long-duration growth stocks. That combination does not guarantee a sell-off, but it makes expensive technology rallies harder to sustain without stronger earnings confirmation. Tuesday's macro calendar is light, so company results and price action should carry more weight. GM is scheduled to release second quarter results around 6:30 a.m. Eastern. Its conference call begins at 8:30 a.m. Traders should focus on auto demand, pricing, margins, guidance, and tariff exposure. At 10 a.m., the Bureau of Labor Statistics releases state employment data for June and usual weekly earnings for the second quarter. Those are lower-tier reports, not major market catalysts. With no top-tier macro release, a failed rally on Tuesday would be harder to blame on the calendar. The next session begins with 4 practical maps. For the S&P 500, support is 7,431, then 7,400. Resistance is 7,458, then 7,500. For SPY, support is 741.51, then 740. Resistance is 743.29, then 748.73. For QQQ, support is 695.51, then 690. Resistance is 700, then 705.80. For SPMO, support is 144.26, then 140. Resistance is 147.45, then 150. Turn the story into 3 testable views. View 1, Monday was a failed risk-on rally. Validation requires SPY to remain below 743.29 and QQQ below 700. The view fails if both reclaim resistance and hold it into the close. View 2, this is rotation, not collapse. Validation requires the S&P 500 to hold 7,400, while energy and semiconductors retain relative strength. The view fails if the index breaks 7,400 on rising volume with broad sector losses. View 3, oil and yields cap technology. Validation requires crude to hold $83.23, while the 10-year remains near 4.60%. The view fails if both retreat and QQQ closes above 705.80. The closing framework is simple. Monday's artificial intelligence rebound was real, but it failed as oil and Treasury yields rose. Below average volume in SPY, QQQ, and SPMO argues against calling the session a broad panic event. At the same time, repeated intraday fades warn that buyers have not regained control. Tuesday does not need another strong open. It needs a close above resistance. Until that happens, treat strength as a test and protect against another late session reversal. This review is for market research only and is not investment advice.